Good morning, everyone. I hope I'm audible. Maureen, can you hear me?
Yes, I can.
So I think we'll get started. Good morning, everyone. Just as Maureen, I hope I'm audible and visible.
Yes, Jackie.
Okay, so we'll get started. On behalf of the Institute of Economic Affairs, I'm very pleased that you've taken your time to join us for our discussion here today. My name is Jacqueline Kagume, and I'd like again to express our gratitude for taking your time to join us for this 12th webinar, IEA's 12th webinar of 2024. As you saw in the invitation notice, today we'll be discussing or interrogating a claim that we've classified as one of the common economic fallacies. And this is the claim that Kenya needs a strong currency. And I'll come to the background regarding that shortly. But before I do that, the IEA is a public policy think tank, and our work is basically to carry out research, policy analysis, and to use the outputs from this to inform decision making in Kenya. And we also, our other big objective is to provide a platform for informed policy discussion. So that's why we convene meetings like this to engage the public, to raise public literacy on what we consider to be important economic policy issues. So we work across 6 policy or program areas, and today's meeting is convened by the Popular Economics Program, and the objective of this program is basically to expand economic literacy on topical economic policy issues, and basically to increase the public's understanding of the role of economics in shaping effective policy solutions. So the PEP program have convened this discussion, and 2 of my colleagues who I'll introduce there shortly will be making the presentation today. So that stated, just to give a very brief background as to how we arrived at the topic of discussion today. So some of you may have participated in the launch of a publication that we did a few years back on 52 economic policies. And basically, the idea behind this was that this program, the PP program, drew up an idea to interrogate what have become some widely accepted economic policy claims or assertions that are stated almost as a matter of fact, but from our understanding, they are mostly or largely untrue. So we, together supported by the other programs of the IEA, the PEP program drew up these 52 economic fallacies, and what we'll be discussing today is one of them. It was basically a discussion or that any country needs a strong currency. And so today we'll be discussing the Kenyan context. So my colleagues will explain why we consider this a fallacy and why that assertion is not backed by sound economic reasoning. So the presentation will be made in 2 parts. To begin with, we'll have Maureen, who works in the program, my colleague Maureen, who works in the program, and thereafter we'll have Kwame, who is our CEO. He also works partly in the program. So the outline will be that Maureen will state and illustrate this claim, and then she'll discuss the economics of foreign exchange, and she'll help us understand some of the pros and cons of a strong currency. Then after Maureen is done, Kwame will come in and he will explain why this is a fallacy, and then he'll summarize our conclusions. As they make the presentation, we ask you to note down any questions that you might have in the chat box, but I'll also allow you to ask verbally during plenary if you have any question. So that's the summary for this. I think we'll just go right into the presentation now. So I'll welcome Maureen to go first. Maureen, you have about 25 minutes. So yeah, you can proceed. Welcome, Maureen.
Okay, thank you, Jackie. My name is Maureen Barasa, and I'll be taking you through the first bit of the presentation on refuting the fallacy, Kenya needs a strong currency. So just the outline, and yeah, Jackie has already broken down the outline. We'll start by stating the claim, then an illustration of statements made just to, yeah, to back up the discussion, then the currencies, different currency systems, the motivation for strong exchange rates, the economics of foreign exchange rate, then the pros and cons of a strong currency, and why is it a fallacy, and finally the conclusion, then we'll call it a day. First and foremost, what's an economic fallacy? We explain this as an economic statement believed to be true, but is factually, empirically, and theoretically incorrect. Remember those words, factually, empirically, or theoretically incorrect. If you place the facts there, use numbers, and also economic theory, it just doesn't make sense. And that's how we conclude it to be an economic fallacy. Then what is the claim that we are presenting today, which is Kenya needs a strong currency. And this has been made by different journalists, uh, politicians, and even as individuals. We think it's right to have, for a country, Kenya, to have a strong currency. And we're going to refute this claim using different facts and theory from economics. And this is made to assume that a weak currency is bad for the economy. And yeah, we're going to find out whether this is true or not. And it's an illustration of statements made. And the first one will be statements made by the president. That was last year in April 11th, saying the dollar rate to go below 120 shillings in the next few months. Well, we're yet to find out whether this has happened. Then his deputy, he said the dollar will soon hit 100 shillings, and if you're holding, sell now. There was tension and all that to make sure that people are sold out their dollars to. They are trying to make sure the Kenyan currency becomes stronger by trying to fix it. Then we have top banker, that's the Chief Executive Officer for Equity Group Holdings, PLC, who says the Kenya shilling's weakening has peaked. This was picked from Bloomberg. We just have a couple of screenshots from different media outlets. Then we have on the Standard, a stable shilling is helpful to our economy than a weakened dollar. Then where the Kenyan shilling has weakened against the US dollar. Then finally we have, okay, not finally, that's the second last one. The Kenyan shilling tips to weaken further on low forex inflows. And finally, the CBK in a bid to try to strengthen, or rather beef up the foreign exchange reserves. They tried to buy dollars to build the foreign exchange reserve. That's from the Business Daily. So just on general definitions, on terms that you're going to be using in this discussion is currency depreciation and currency appreciation. And we define currency depreciation as a fall in value of a currency against other currencies and a floating exchange rate system. And currency appreciation is more or less the reverse, which is an increase in the value of a currency relative to another and a floating exchange rate system. And a currency is a price and it's measured across other currencies globally. And just to explain a bit of the history of establishment of global foreign exchange markets, it started as different countries relying on goods and services of other countries, and this is due to different comparative advantages. This led to the US dollar rise to being a world reserve currency, making it a reference of comparison against other currencies. And that's how currency depreciation and appreciation comes about. And the rise and fall of a currency relative to other currency is more or less driven by market forces, that is supply and demand, and you're going to see it in our future slides. Then just to explain currency systems. Currency system is a framework or set of rules that governs the creation, all the way from the creation, issuance, circulation, and exchange of a country's currency. So we are going to look at different four currency systems and countries that are involved in the different currency that practice the different currency systems. So, and I'll be calling them the exchange rate, and the exchange rate is the price of the foreign currency. So you have the first one will be the free floating, or rather the also known as the flexible exchange rate. And the free floating or flexible exchange rate is the value of a country's currency and is determined by demand and supply forces. And in this currency system, the central bank is not involved in the foreign exchange market. So currencies are the strength, or rather, the rate of the exchange rate is determined by supply and demand forces, how the market plays out to achieve an equilibrium. And the countries that are involved in this are Australia, the United Kingdom, Japan, and the United States. Then we have the fixed exchange rate, which is the value of a country's currency and is assigned to a central fixed per value in the system, and commitment to maintain it is through buying and selling. And the central bank in this case is an active trader in the foreign exchange market. The central bank intervenes in case there's an appreciation or depreciation of currency. And the countries that are involved in this fixed exchange rate is Aruba, the Bahamas, Bahrain, Hong Kong, Iraq, Saudi Arabia, Macau, Djibouti, and Cuba. Then the next currency system, we have the managed floating or intermediate exchange rate. For the managed floating exchange rate or intermediate, which is more or less they're used interchangeably. In this case, the central banks intervene in the foreign exchange market by leaning against the wind. The central or the currency system by pure fixing or pure floating, like what the central bank has been trying to do. Like we've seen in this slide, the central bank buys dollar to build the foreign exchange reserve. That's trying to operate managed floating or intermediate exchange rate. And lastly, we have the currency board exchange rate, and this occurs when a country supports its currency with gold or reserves. And this is evident in Zimbabwe, where they've been trying to use gold to support their currency. And majority of countries are in the managed floating exchange rate system. That's Kenya included. But more they sort of fixate between the fixed exchange rate and the managed floating or intermediate exchange rate most of the time. Then we have motivation for strong exchange rates. We identify three major motivations for a strong exchange rate. We have the political motivation. We've seen politicians trying to make statements about the shilling appreciating to 120 shillings against the dollar, and also reduced import costs, protecting goods domestically, whereby people will be more motivated to trade to buy local goods than importing, because the import costs will be quite high. And yeah, we've seen this during when there was a huge depreciation of currency, that is in 2023 and 2024. We've seen people articles on car purchase, whereby people preferred to purchase cars locally than import because of the cost. And then there's debt liability because of the debt servicing cost for external debts, which is repaid in foreign currency. A strong exchange rate is significant, as it will reduce the interest rate and also the principal when repaying debts, external debts. And then we have the economics of foreign exchange, and under this we'll be looking at the drivers of currency depreciation. For the drivers of currency depreciation, we identified a couple, which is one of them is the global shocks, and we identified geopolitical tension, global recession, natural disasters. They can all be drivers of currency depreciation. Like recently, we had the Russia-Ukraine war. We had the issues with oil, and they sort of acted as drivers to currency depreciation. Then we have the monetary policy action, which involves interest rate adjustments, quantitative easing, and interventions in foreign exchange markets, can all lead to depreciation of the currency. Whatever policies or actions the central bank takes can affect the currency by depreciating the currency. Then you have the high public debt. High levels of public debt relative to GDP can raise concerns about fiscal sustainability, and repayment of huge external debt contributes to currency depreciation. If we have a huge external public debt, both as principal and interest, and also the maturity period is shorter, it sort of affects currency and leads to depreciation. Then we have slowing exports, and by slowing exports, we interpret it as persistent trade deficits, where a country imports more than it exports. This leads to depreciation of a currency. Then we have political instability. On political instability, conflicts or governance issues, they undermine investor confidence and lead to capital outflows, causing currency depreciation. If there are issues with the rule of law and all that, it affects investor confidence. Then we have high inflation rates. And on this, we explain it as elevated inflation rates can reduce the purchasing power of a currency, making it less attractive to investors and leading to depreciation. Not only does it affect the purchasing power of the domestic consumers, it also affects foreign investors if currency depreciation occurs. Next, we'll be looking at a chart on Kenya's currency performance since liberalization, sorry. And this is January. We took data for the month of January across all years from 1993 all the way to 2024. And it's across three different foreign currencies. We have the US dollar, the sterling pound, and the euro. The US dollar is the one in blue. Then you have the sterling pound is the one in orange. Then you have the euro, which is in the euro is in green, yeah. So if we look at this data, the performance has been sort of it's a mixed trend. There are moments of appreciation and depreciation of the currency, and most of the depreciation was witnessed in 2023 and 2024, and this can be attributed to the global shock. Yes, due to the geopolitical tensions and all that. Next, we'll be looking at the drivers of currency appreciation. And the first one you have is trade surplus. If a country exports more than it imports, it can lead to appreciation as there's high demand for the exporting country's currency to pay for its goods and services. And yeah, this is how trade surplus leads to currency appreciation. So for Kenya, we haven't witnessed trade surplus since the imports, at some point, the imports surpassed the exports. And we have low inflation rates. And for the low inflation rates, this is through maintaining the purchasing power of the currency, whereby domestic consumers can be able to purchase different baskets of goods, and they're able to maintain a stable standard of living due to the low inflation rates. Then we have the high interest rates and reduced money supply. And for this, interest rates increase, making investments denominated in the currency more attractive for foreign investors, and a reduction of money supply for the purpose of price stability. All these contribute to currency appreciation. Then you have foreign direct investments and inflows from the foreign direct investments can increase demand for currency, and this leads to appreciation. And this was witnessed whereby we had promises from the World Bank, and we had also had the infrastructure bond. Then finally, you have political stability. And for the political stability, it's common that a stable political environment, effective governance, and the rule of law can instill investor confidence, and this attracts capital inflows from the foreign investors, leading to currency appreciation. Then we'll be looking at the pros and cons of currency depreciation as the final slide on my presentation. And for the pros and cons of a strong currency, yeah, a strong currency, as much as you're debating to have a strong currency by increasing the value of the currency, it has the pros and the cons. And the first advantage of a strong currency, we explained it as lowering external debt servicing costs. And by this, we mean that it reduces interest payments on foreign denominated debt, and it lowers borrowing costs for governments and firms during repayment of interest and also principal. If the currency is strong against the dollar, it makes it reduces the external debt servicing costs, and it also it reduces inflation by reducing the price of imports resulting from a foreign currency can help keep inflation rates in check. And this benefits the consumers by maintaining stability of prices and the currency's purchasing power. Then we have it attracts FDI as another advantage, and investors seeking to benefit from the stability and potential appreciation of a currency, they'll invest more if the currency is stronger. Then for the disadvantages, we have two, and one of them is it could widen the trade deficit. We've seen before that it makes exports more expensive and imports cheaper. And by so doing, it weakens the country's position in global markets, leading to a loss of competitiveness in certain industries, largely those dependent on exports, whereby it will make goods that are exported more expensive for foreign consumers than what is imported, and this leads to it widens the trade deficit between the imports and the exports. Then we have the last thing is reduced export competitiveness, and reduced export competitiveness of domestic goods in international markets reduced competitiveness of domestic products in international markets because the exports become more expensive for foreign consumers. This is more or less tied to the first point on the disadvantages. When the domestic products become more expensive for foreign consumers, it reduces the export competitiveness because there'll be less demand for that product in the foreign markets compared to what is being imported. Yeah, thank you. That's the end of my presentation.
Yeah, thanks a lot, Maureen. Kwame?
All right. Okay, thanks. So our colleague Maureen has taken us through the economics and drivers of the prices of currencies. The exchange rate for one currency against the other is the price of one currency relative to one or relative to others. She's also reminded us that the economics of this tells you that prices are relative in the sense that it's one against the other. But when you change the price of one, say you try to change the price of one good, or in this case, a currency, it also changes that price of that currency relative to many other currencies, because there's many currencies as there are countries, though of course she's told us that some countries share currencies. At the same time, I think she's also said that there are different forms of currency management systems, starting from free-floating currencies. You have mandate currencies. You have currencies that are backed by a commodity, or in some cases backed by gold, such as the currency board. Of course, one of those is Zimbabwe, which introduced a digital currency, which is also backing with gold. It hasn't gone too well because it fluctuated by 50% in the first month alone. And then we had a managed float. Now, if you look at these currency systems, it depends on what other economic decisions or other policy the country adopts, and a free floating and on a flexible exchange rate tends to be adopted, or rather it seems to have been adopted by many countries with very high income. So we're talking here Japan, United States, Australia, and the United Kingdom, among others, but these tend to be the bigger ones in general. They haven't done poorly at all. And then the fixed exchange rates are adopted by certain countries, which tend to fix it against either against existing currencies, in some cases, such as the Bahamas, which fixes its currency relative to the US dollar. Aruba, Bahrain also fixes it relative to some other regional currencies. The managed floating currencies obviously manage float, in other words, let it float, but also intervenes as conditions might require or are considered expedient. Then we have, of course, Zimbabwe and other countries that have that. Now, we are asking ourselves, so why do we say it is a fallacy to seek a strong currency? And I think Maureen has told us that the only way you're going to seek a strong currency is to accept that you will not let it to free float, basically. It means that on the spectrum from free-floating currencies to managed currencies or pegged currencies, it means you're seeking to go towards more control by government or government agencies in that currency. And that usually requires central bank intervention. And we argue that it's a fallacy because seeking a strong currency will have the effects that my colleagues has mentioned, but it's usually not without cost. There's an opportunity cost, or you give up something by choosing to make a currency strong. Let's even assume that it is possible. But I'm arguing that trying to make a currency strong is something you can only do for momentary reasons. And then over time, that generates other costs, which have to be borne regardless of whether the currency remains at whatever level is required or not. Maureen also told us that the motivation for a strong currency can come from three places. One of them, obviously, is a protectionist need, which is basically to protect domestic industries or to prevent imports by making a currency defend against imports. By a strong currency means that imports become expensive. So therefore, trying to change the trade balance between one country and its external partners. You can also have a political motivation. Part of it might be just basically nationalism, which is the belief that a strong currency is good and it projects a strong economy. That's not necessarily true, but that belief also exists. But the other one would also be because in Kenya's case, we think this is the most important one because we saw initiatives towards, or rather, we saw proclamations, mostly by politicians, but people in the public sector, to strengthen Kenya's currency towards 120 in the belief and the quest to actually reduce debt service obligations. So we see that all those things could come to play. So why is it a fallacy? Because first, to have a strong currency, especially in Kenya, seeking a strong currency means you'll actually have to seek intervention by the central bank. Why? Because Kenya's exports are not very strong and Kenya has not been export competitive in the last 10 years. So that's one. And one of the things that the central bank intervention means that they would sell dollars or foreign currency to prop up the Kenyan shilling means that you are foregoing those currencies. But what a central bank can only change is what we call the nominal exchange rate, which is basically what's the exchange rate that is quoted when you go to whatever dealer you're dealing with to actually give you the Kenyan shilling. So for instance, the 120, which is what Kenyans are fixated with, or at least the politicians that we spoke about are fixated with, comes from the fact that they want the exchange rate on a given day, on a moment, to reflect at 120 shillings to the dollar. But it does not but it does not change, sorry. So a fixation with a nominal exchange rate, which is what the exchange rate would be if you go today to change your shillings for dollars, is what they can change. What it does not change is what is called the real exchange rate. And the real exchange rate basically is relative to the fact that when you change one currency relative to others, a currency is not an end in itself. It's not a currency. It's not something you can consume. It is something that you use in exchange for goods and services. So what does it change in terms of the buying power of that currency relative to others, but also relative to the goods and services that are produced from other parts of the world? That's what's called the real exchange rate, which is basically the determination of how a currency, buying power of a currency has shifted the ability to buy goods produced within that country and also with its main trade partners. I'll be showing a chart that shows that that does not change, and therefore the CBK, the central bank anyway, trying to intervene towards managing the nominal exchange rate does not change that external factor. We also think that basically, as Maureen has said, when you decide to seek a strong exchange rate, in other words, making Kenyan currency stronger by changing the nominal exchange rate, what you do is that you make exporters earn less money for the exports. And you make importers capable of buying a little bit more. So for instance, if something was $10, for instance, let's use dollar as an example, a book for $10, for instance, it means if you are seeking an exchange rate of say 120, and earlier it was at 150, it means that a book that would have cost 150 in the short term would have cost 1,500, but in the short term cost 1,200. And what that means is you're making imports cheaper in nominal terms, but what you're doing is you're making exporters earn less, because for the same quantity of books, say for instance, a Kenyan is selling a book outside and it costs $10 principally, which would have earned him 1,500 shillings, it would now earn 1,200 shillings, and therefore they've taken that cost. So anytime a country seeks a weak but in this case, a strong currency, you are shifting income between importers and exporters, which is a political question. And that's all you're doing. And then the second one, the third one is a point. There's a Canadian economist called Robert Mundell who won the Nobel Prize in Economics, I think in 1999. And Robert Mundell established something that's called the impossible trinity. So this is monetary policy. Monetary policy has three aggregates. If you're seeking a fixed exchange rate, free flow of money, and keeping an independent monetary policy is not all possible. So I'll be demonstrating in our arguments from economics theory and the empirical part, these three reasons tell you why it's a fallacy to seek a strong currency on as an end in itself. So in the next chart, so we are here, I'm trying to demonstrate what the nominal and real effective exchange rate is, which is basically the nominal exchange rate is what it tells you. So you can see that reddish orange line tells us what the nominal exchange rate in Kenya has been from 2000, sorry, from the 1st of January 2001, the blue line, right? Yes, tells you what the real exchange rate, what the exchange rate in Kenya has been, the nominal value. So in 2001, the Kenya shilling was close to about 71 or 70 shillings. They're about slightly more than 70 shillings, below 80 shillings, right? And that's how it's changed all the way to 2022 on the 1st of January. So those are nominal figures. Basically, what that means, if you go to a bureau, if you're buying money from your bank, that's the average amount that you pay. And that's what that blue line, threaded line tells you. Now, the dotted line tells you what the trend line would have been across that. The nominal effective exchange rate, which comes down under the red line, when you adjust, or rather, the real line is the blue line, which basically what it tells you what the buying power of the currency would be, taking account of the real exchange rates, adjusting for inflation and all that. Because if you adjust for inflation, if inflation is higher between, say, Kenya and another country, the exchange rates and the buying power of the currency should reflect that. So the blue line is telling you what the real effective exchange rate would be if you take account of inflation and Kenya's trade position. The red line, which is basically the pinkish line, the orange line, tells you what the nominal value is if you take its nominal value. And if you come from 2002 towards it, that difference between those two tells you that the gap between what the real effective exchange rate should be, which is about 130, and what the nominal exchange rate should be, is telling you if you account for inflation. Kenya's inflation has been around 5, 6, sometimes as much as 8% every year. And you adjust it for the size of, for the shilling, the buying power of the shilling, and then look at what the Kenya shilling exchanges for the US dollar, taking the US dollar, for instance, as well, and what the goods rate is. That gap tells you that the adjustment is necessary. And what that tells you is that regardless of the fact that today the Kenyan shilling is nominally, if you adjust and take account of that, closer to that 120, the real value should be about 140. And that gap in itself tells you that that adjustment is still coming, because the function of dollars and the function of the shilling is to buy goods. It's not by itself only a price. So it's telling you what its buying power is. So we think anybody who's seeking a strong shilling is ignoring this, the difference between the nominal and real exchange rates. Let's go now to the next. So that's the first part about it. The second part is about the impossible trinity. It's called the policy trilemma. The Robert Mundell, an economist who won the Nobel Prize in 1999 and studied monetary policy. So he says that a monetary policy authority, which would be the government or the central bank authority, has three options. You can allow for free capital mobility between countries. So for instance, capital mobility, which is free mobility of capital between, say, Kenya and outside the US in terms of US dollar or whatever other country. Monetary autonomy, which is basically the autonomy where a monetary authority, such as a central bank, would make decisions independently. Or exchange rate management. So these are options that you can choose to, but for which it is not possible to get all of them. Now, a fixed exchange rate means that once you've fixed your exchange rates, you either lose monetary autonomy or you cannot allow for free mobility of capital. For instance, if you have a fixed exchange rate, free mobility of capital definitely is either compromised, or if you want to allow that free mobility of capital, then it means that the monetary autonomy has to be surrendered, because then the monetary authority does not have would not be able to fix the exchange rate. And to fix that exchange rate and still at the meantime maintain capital mobility. Because if you fix the exchange rate and it does not signal it does not give the right signal to the people who want that capital will flee. So if you want capital mobility and you want a fixed exchange rate and you want monetary autonomy, those three are not compatible with each other. And I think this is what this is telling us as well. So in Kenya's case, free capital mobility would not be consistent with a strong currency lying at 120 if the monetary autonomy is to be maintained. Because what that means is there'll be no monetary autonomy. You simply choose to limit free capital, or if you leave free capital mobility to happen and exchange rate management at the same time, you do not have monetary autonomy, because then you have to read signals from the market. If you, however, want monetary autonomy to be able to make that decision, then you can only have free capital mobility, right? And the exchange rate management would not happen, because then you cannot control the exchange rate. Partly because markets function especially in that way. So if you accept mechanism for market functions, then the price signals means you can only have free capital mobility and without exchange rate management, because if you have exchange rate management, then the monetary authority has no decision to make. So as we come to this, what we're just trying to say is, if you think about it, this is a fallacy, because this impossible trinity is not just mathematical, it's empirically established. And in Kenya's case, it shows that this choice needs to be made, and you cannot have your cake and eat it. So either we can choose free mobility of capital, but if you're going to limit the exchange rate to 120, then it means you have no monetary autonomy, because you cannot adjust the exchange rate on one side or the other. So whatever choices are made, it's telling us that it is incompatible to choose and to try to keep this. And because we still have free mobility of capital, we have a monetary autonomy which is guaranteed by the Constitution for the central bank to make decisions. Then the exchange rate management is something that has to be sacrificed. Or that monetary autonomy would have to be surrendered if the exchange rate management is coming back and free capital mobility. That's the sense of these choices that have to be made. So as I conclude, what then does that leave? I think a sensible policy choice, in the next slide, a sensible policy choice the government must choose in Kenya's case is to take account of the fact that, I think my colleague Maureen mentioned, but I need to emphasize, Kenya is one of those countries that's called a small and open economy. Small open economies have certain characteristics. It is not possible for the government of Kenya to have enough money to even defend the currency if there was an attack upon it, or if it was going down, or if it was rising. So one of the things, the sensible thing, is actually to seek the stability of the currency. Now, stability of the currency is to ensure that it's stable and predictable on the path. That's very different from trying to fix its nominal value at 120, 130, or whatever number we choose to fix it for the US dollar, or whatever number we choose to fix it, say, for the South African rand or anything else. It's determining and trying to determine too many aggregates. And remember, the three of them alone in the policy trilemma tells us that it is not possible. So in our view, the idea that a strong currency is useful for any economy might make political sense, and you may use political sense to actually political arguments or some protectionist arguments to keep it, but you lose the fight in the end, because it is not possible to achieve both a strong economy and the independence that is sought, and to actually look at the history and determine whether it's good policy. So it's not good policy. I think the currency in itself is a price, and trying to control the price on its own means you're not thinking about what the knock-on effects are. It's not sustainable to start with for a long time for a country of this nature. But at the same time, to say that a country needs a strong currency actually is saying nothing, because strong currency is a reflection of what the prices are. And to seek a strong currency as an end itself means you're actually anchoring it in a price taking you back to price control for the exchange of currencies. And that's not possible because one country can only control, more often than not, only control its own currencies, and other countries control others. And the action of markets suggests that it's not a very smart policy to seek to control, to have strong currency, in addition to the fact that it's a fallacy that a strong currency is good for any country. Thank you.
Right. Thank you. Thanks a lot, Kwame, and thanks, Maureen. So to summarize, because I've been given this moderator's role, I think the three, if I was to summarize what our speakers today have said, the three main takeaways that I've had is first, the value of the shilling is determined by market forces of demand and supply, and therefore this means obviously that the exchange rates fluctuation is based on economic conditions. I think we had that from Maureen, and this is not peculiar to Kenya. I mean, it's common practice in many countries, and so that is primarily determined by market forces. Then we also had my other key takeaway from the discussion we've had. They've said here that changes in the exchange rates, including the depreciation, can help in correcting market imbalances. And I think the illustration has been made here with that example that a weaker shilling can be beneficial to exporters by making our local goods, more competitive in international markets, which of course improves Kenya's overall trade balance. And so that was just one of the examples. Then the third one that I've had was regarding the role of the central bank. How should they intervene? What's the role of the central bank? And I think my summary here would be that it's been stated that their approach should be to maintain a policy, the monetary policy of not necessarily targeting a specific exchange rate level, but rather checking to ensure that there is overall price stability, but still within the framework of a floating exchange rate system. So the intervention should just be to prevent the volatility and to prevent that excessive volatility. So, and I think Kwame has summarized that towards the end with the diagram of that trinity, the impossible trinity. And in summary, putting everything together, I think our two speakers have helped us to see that a weak or a strong shilling is not necessarily, or it's not inherently good or bad. So that's what Maureen was trying to say when she demonstrated to us the pros and cons. And so stating that Kenya needs a strong currency is then demonstrated to be a fallacy. So that has been our discussion this morning. I hope I've summarized it accurately. And we'll now go to the plenary session. And to start us off, I think I see one question on the chat box, but I'll also give an opportunity to anyone who'd like to ask their question. If you have a question that you'd like to ask verbally, you can raise your hand and I'll see you. Then as you prepare to do that, I see one question here by Faith Nzomo, who asks, does a strong currency attract or deter FDI? So both Maureen and Kwame, you can prepare to respond to that. Then Collins asks, thank you for the presentation. It's simple and clear. My question is, what triggers the formation of a parallel exchange rate in an economy? And is a parallel exchange rate the same as black market rate? So that's a question from Collins. And then I think Maureen has tried to explain, to respond to the first question. But does anyone have a question? I don't see any hands raised. Does anyone have a question that you'd like to add to that? So as we prepare to have any verbal questions, I think I'll invite you, Maureen, to respond to the to give what are your responses to those questions first. Then we come to Kwame. Mo?
Okay, I'd like to respond to Colin's question on what triggers the formation of a parallel exchange rate in an economy, and is a parallel exchange rate system same as a black market rate. And I tend to think a parallel exchange rate is, it runs concurrently with what the central bank has stated as the exchange rates of a certain currency. And it's also known as the black market rate. And I'll say it's due to interventions by government on the exchange rate. And so people, demand and supply forces people to seek alternative, which is the parallel exchange rates in an economy. I'll say it's the intervention by the central bank in the foreign exchange market. Yeah, thank you.
Thanks, Mo. Kwame, would you like to add to those responses?
Yes, I would. So two things. So the first question, I think, is about a parallel exchange rate. I think Mo has mentioned it, but this is it, yes. If you have a floating exchange rate, then usually you find that what it means is that you have spot markets, which means if somebody goes down to buy some foreign exchange, say buying dollars against, say, sterling pounds, a price will be quoted. They can consider whether those prices are the appropriate ones and then buy regardless, or not buy it and seek an alternative. So that means that there's competition for that price to reach its most efficient level based on basic economics. So that's the market price, right? There'll be an average price based on the quantities that are purchased and all that. Now, parallel price only exists where there's guidance, whether by the central bank or some government or monetary authority, that says the Kenya shilling, and we have them in countries even around and about East Africa. Ethiopia had one. Some countries control prices as well, so they have, control the currency as well, currency controls. So they say the price is this. Kenya had it before 1994, when it was stated that, for instance, the Kenya shilling was, say, 23 shillings to the dollar, or 44 shillings to the sterling pound. This was mid-90s. Now, what that meant was that only a given quantity of dollars or pounds was available. It was rationed by the central bank. But there were people who, for some reason or the other, had the ability to find you, and they tell you, look, if you're looking for dollars because you want to travel outside the country, or you're looking for to other places, we can find it for you, but it will not be the official rate. There's a parallel rate. And that is really a reflection that, yes, the market is not working efficiently. So government says it's 44, but you could go and find sterling pounds for 60 shillings, and some person would give it to you, ask you to hide it. And in many cases, it also happens. If any of you has read Micah Cheserem, one of the most outstanding of the central bank governors that we've had, in his book, please check his biography. And one of the things he wrote when he came in, among the things he came in, I think he came in 96, maybe 94, 95 or thereabouts. And one of the things, 96, I think. And one of the things that he wrote was that he found out that because Kenya had a controlled exchange rate, staff at the Central Bank of Kenya in those days were actually not staff, board members were buying currency from government at one rate, which was controlled, and then by arbitrage, flipping it off to other people, and including businessmen who needed to buy some things outside them. Because that's why you say there's a parallel. Yes, it's a black market, because when a government controls the exchange rate, that means there's a legal rate, and if you trade outside that, it's a price control. If you trade outside that, you can actually be prosecuted. And we had regulations in Kenya against not just keeping foreign currency above a certain level, but you needed to apply to the central bank to get it. So when to actually be approved, and it would be in part of your passport to actually show how much you applied for, what are you going to do with it, and then you get it. And when you come back, you'd have to account for any balances that existed. So those conditions create rates. In some countries as well, you have people trading it, and some people say that some neighboring countries have that, where the official rate is stated by the central bank. But if you go to some markets, you're still able to find rates for which, of course, you pay a premium. So that's a parallel market rate, and it's usually a reflection that the market is not working efficiently because the rate that has been placed by government or by law is not what the market accepts. So demand is much, much higher, and therefore the rationing by that price is creating and inefficiency. So does a strong currency attract or deter or deter FDI? So what is FDI? FDI is foreign direct investment. And foreign direct investment says that if the Kenyan currency is, remember, the word strong or weak is not by itself very meaningful. It only means strong relative to what, right? And the real effective exchange rate would obviously usually tell you what the real rates are relative to how you buy goods and services. But if you keep it nominally, so for instance, you say it's 110, in Kenya 120, you would expect that what it would do is actually deter foreign direct investments, because a person says, if I send my dollar into Kenya today for foreign direct investment, right, and it is at 120, when the value and the alternative value in another price would be about 140, I am actually putting myself at a disadvantage, because in my imports are going to be, might be cheaper, but the value of my cash, the value of my investment is actually lower than the nominal rates reflect. So yes, not always, but if there's a very big misalignment between the real effective exchange rate and the nominal exchange rate, yes, you will see that it will definitely deter FDR. And I think we can test for that. I think the Kenya shilling moved very abruptly from about 150, 154, if I remember right, in 12th of January. 12th of February, no, 13th of February, it came down to about 140 and started to slide back on Valentine's Day. I don't know that that's a Valentine's gift to who, but some people suddenly liked it. So we can check whether that change on its own, measured against the RER, will bring in more investments or not, because we can test that theory here. But on the whole, if you look at what the standard tells us, yes, if there's a big misalignment and there's a control, or if the depreciation takes place, or rather if a strong currency takes place, which means you're actually making the currency to appreciate, giving it higher value than the market suggests it should, then obviously you're making goods expensive. And investment is a good itself. And so you're making that expensive as well. And remember, investment is like a form of export, because somebody's bringing in their money to invest in Kenya or to buy Kenyan goods. Yes, it could deter investment. Thank you.
Thanks for your responses, Maureen and Kwame. So I do not see any other question. Would anyone like to ask a question orally? I do not see any hand raised. I see some contribution. Emmanuel here makes some additions. Would you like to explain what you mean, Emmanuel? Or should we just read and interpret your comment?
Okay, I can make an attempt. Okay.
Yes, please.
So what I understand is that when it comes to the question of what drives FDI, and because we're talking here specifically about currencies, then if we look at just the currency itself before asking ourselves about the fundamentals, then the strength of a currency is not enough information. Then maybe an investor would like to look at, okay, what is the relative strength? So compared to other currencies, and what is its stability over time? So if a currency is excessively volatile, then that in itself might not be a confidence boosting indicator. And then yeah.
Sorry. Thanks, Emmanuel. We'll see whether Kwame and Maureen agree with you. Before I close this discussion, because I still don't see any other question, I'm giving one final opportunity to anyone who would like to ask a question before we come to the closing remarks from our speakers. Okay. I do not see any, so I think we can just summarize. I guess Emmanuel, your hand is up.
Yeah.
Okay.
I
Go ahead.
Thanks. I wanted to ask the panel what they think the feedback mechanism that just, or the incentives in place that push a country like Kenya to continue to manage its currency, even though we know the effects of that, and then what they think about how that could possibly be corrected.
Yeah, I think that's a useful question because I'm sure that they are very well aware of the economics reasoning that has been shared here with us, but they still go ahead and manage the currency despite the cons that we've had here today. So I think, Maureen, you can attempt to respond to Emmanuel. So what drives those decisions by the central bank? What do you think are some of the incentives that they're that causes them to make those decisions, and what can be done, as Emmanuel has asked, to sort of address before we come to Kwame? Maureen?
Okay, thank you, Manuel, for that question. If we go back to the presentation, we had the motivations for a stronger currency, and we had like three main points. That was political, debt repayment, and reducing import costs. And majorly, we've seen the intervention of the central bank in trying to buy dollars to boost the foreign currency reserves. And this was mainly one of the major reasons was for debt, the debt liability, trying to repay debt. And from our presentation, we've seen that it's best to have a floating exchange rate regime whereby we let supply and demand forces to determine an equilibrium in the foreign exchange market instead of trying to control it. Yeah. Thanks.
Yeah, thanks, Maureen. Kwame?
Okay. Responding to the question on how can the incentives to manage currency be weakened by the central bank? Yeah, I think that's a difficult question to give a solid answer to for two reasons. One of them is that constitutionally, the central bank and the monetary authority, the central bank, are supposed to run their operations without guidance from anybody else. It means when the central bank governor is appointed, sorry, I couldn't get the appropriate part in the constitution, but I'll search for it before we close. It's explicit that the governor, or rather the central bank, not the governor, but the central bank, will run monetary authority without, I paraphrase, coercion or influence from any office. So that's an independent office in every respect, including by constitutional protection. What that means is that the central bank authorities are required to take judgment on what's best for the economy or whatever it is they wish to achieve, and communicate that, and then make those decisions independently, which means authorities that tend to have that kind of influence, the constitution does not tell them then that you should run a managed float or a free exchange, or a free floating currency. But one thing that is implied, I read this implied, not everybody would agree, but it's implied, is because historically countries that provide autonomy to the central bank are the countries that we saw as managing, as adopting free monetary, unhindered monetary policy, which are the countries that actually float the exchange rates. So if we make inference, our view, we would argue that the framers of Kenya's constitution intended for a floating currency. But because they have judgment, it is possible that that freedom and constitutional protection is also allowed for the holders of that office to use their discretion and to explain that discretion to Parliament or whoever they're responsible to. So now that you asked that question, I think that's why the confirmatory hearings, what are they called? The hearings that are held for confirmation of a central bank governor and the deputy at Parliament and the National Assembly are extremely important, are very important. The hearings that are held required by the Constitution, or rather, the confirmation hearings that are held for governance of the central bank are important, because then we can ventilate those questions at that level to ask them whether, one, they understand the protection that the Constitution has given them not to take political or other political or other guidance from anybody else, what their interpretation of that their independence means, and then secondly, what do they think are the aggregates that they need to? Because the Central Bank Act talks about basically managing a stable prices, and stable prices means even the exchange rate is a price. So its stability, I think, is embedded in the laws and the statutes that govern it. I think I've used a very long and woolly answer, but my view is that your question is quite interesting. And then the final one is, what feedback mechanism and incentives are in place to manage the currency? So that you say you asked in the, and I think it's the same. We expect a competent management of the monetary policy. And part of competent management is then to isolate and to give those monetary policies legal cover through the Constitution, no less an institution than the Constitution. So I think what we then should question them about is, you have that authority, please explain your judgments to us and your decisions. And I think this institution tries, because every so often the Monetary Policy Committee holds, I think every 6 weeks after they meet, they hold a meeting at which they explain why. Well, the notes are usually sketchy, to be honest, but they explain why they have kept the interest rate where it is. Because even by keeping the interest rates where it is, they affect monetary policy. Remember that trilemma? It affects even the exchange rate. And last year in December, you saw a very huge hike. I think it was 3 percentage points, which is what the economists and the bondholders called 350 basis points, to confuse simple men like you and I. And by raising it by 3 percentage points, what they meant was that government bonds were really, really lucrative, came down from about 12%, about 15% to close to 18%. And what that does is the investment function, which basically attracts more currencies into the country. And that can actually make the Kenya shilling a little bit stronger, because you're inviting dollars into the country. And at that point, they mentioned, without being very explicit about it, that part of that was they were concerned about the continued degradation in the value of the Kenya shilling. So yes, it's connected to the constitutional part. And I think that's why this conversation is important. You cannot discuss monetary policy without talking about the constitutional protections that are provided to the central bank. Thank you.
Great. Thanks a lot for those comments. I don't see any other question. So I think we'll just close the discussion now so that we can keep to the time allocated to this. Before we do that, I'd like to give 30 seconds or less to Maureen and Kwame each to make their closing remarks before we wrap up. So Maureen, if there's anything you would like to add in closing remarks.
Thank you, Jackie. I'd just like to say thank you, everyone, for attending the webinar. And please be on the lookout for our presentations and the compilation on the 52 economic fallacies. It's posted on the IEA website. It's a good read. Make sure you pass by and read it. Thank you, everyone, and have a good afternoon.
Thank you. Thanks, Maureen. Kwame, your closing remarks.
All right, thanks. The only thing that this stresses for us is, yes, when you talk about a strong currency, and especially when the strong currency comes from political rhetoric, then we are careful at the Institute of Economic Affairs, because it's suggesting to us that political leadership might have legitimate or valid reasons in their side, are trying to influence the performance of a constitutional body which has been granted the right to make, which has been granted the protection to make independent decisions. And so that's an interesting part about it. But also what it tells you is that Kenya's constitution, by giving the central bank its own authority and fencing it off from political and other pressures, is actually codifying economic policy. Thank you.
All right, and I think we can close it at that. So again, on behalf of the IEA, I thank you most sincerely for joining this discussion. We hope it has been useful to you and that maybe you have learned something new, or you'll have some rebuttals to make if you hear anyone advancing this claim without giving any qualifications to the fallacy. So I thank my colleagues, Kwame and Maureen, for preparing the presentation and sharing it with us. As Maureen has stated, it will be available, it will be posted on the IEA's website, the presentation, but the publication that comprises the entire list and reasoning behind the other 52 economic fallacies is already available on IEA's website. So just go to our website and then you search for economic fallacies and you'll be able to access that. So we thank you for joining this discussion. The IEA is a membership institution. So I see some of you here are members, but for those who'd also like to become part of our members, please reach out to our communications team. They'll be able to assist you on how to become a member. So I think that stated, we'll end this discussion here. Look out for more notices for similar discussions on IEA's social media pages, and we'll always be glad to have you here. So I thank you very much, and we wish you a lovely afternoon. Thanks and goodbye.